Well, with all of this, we got the April jobs report hitting the tape about, 17 hours from now. 8:30 a.m. tomorrow morning, we get the April non-farm payrolls report. Expectations are for a gain of 391,000 jobs. And if it comes in there, that would be the record 12th consecutive month of gains around or above 400,000. Unemployment, well, that rate is expected to fall 0.1% to 3.5%. That would be the lowest level we've seen since the pandemic started. Federal Reserve Chairman Jerome Powell said yesterday the Fed believes there is a path to taming red-hot inflation without causing a recession or pushing unemployment back up.
We need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done.
Well, some of this is in question at the moment. Joining me now with a brilliant macroeconomic context that we all need is Grant Thornton's chief economist, Diane Swonk. Diane, first, what is your expectation for the jobs number tomorrow for the month of April? And if it does even better than what the world is expecting, what does that mean for the markets and for what Jay Powell said is his path forward?
Well, it's really critical. I think we could see more than 400,000, closer to 450,000. That would be about the same 431,000 that we saw in March. We generated 1.7 million jobs in the first quarter. That would have been an okay year in the 2010s. In one quarter. And that's the same pace we saw in 2021. What's most important about the job situation is sort of an untold story here that is unpacked in the data that we got today. And you nailed it when you talked about unit labor costs going up. They rose at an 11.3% year-over-year rate, the highest rate since 1982. Embedded in that, yes, wages are accelerating, but not as fast as inflation. Unit labor costs are going up faster than inflation because productivity growth plunged at its fastest pace since 1947. The churn in the labor market, employers having to replace workers, pay up and train those workers, those workers and talent they lost, that's costing us productivity. And let's face it, in the hybrid work from home environment, it initially boosted productivity growth because we all allocated more time that we weren't commuting to our jobs, but it does make it easier in a very tight labor market where job demand, almost 2 jobs per workers looking for a job, is so easy out there. In between teams meetings, people are taking Zoom calls and interviewing and getting picked off. Ooh. I think that's really important to understand, is that churn being very costly, and it is one of the things that keeps the Fed awake at night, because what that means is that you can't have wage gains that improve living standards. Instead, you're having wage gains that are accelerating, but not as fast as inflation. They're chasing inflation, chasing a moving target, eroding living standards. And at the end of the day, even Chairman Powell admitted, although there is a path, it's a very narrow path to get to that soft landing. And then he said, he also qualified it softish landing. That's kind of hard to me. And our reality is that we think we're going to have to see unemployment rise above 5% before this inflation is brought back down to the levels that
this is the issue.
And that's a harder landing.
These great job opportunities for people. I mean, finally, if you think about the rest of the world, not just the C-suite who's all worried about, oh, I got to pay workers more. This is great for, under normal circumstances, for the economy, that jobs are plentiful and that people have choices. However, with it paired with the inflation that we see, whatever job gains they get are being sucked up by higher prices that they have to pay everywhere. When you heard that Jay Powell said yesterday, right during this hour, I'm taking 75 basis points, that we are not actively considering any hikes bigger than 50 basis points. What was your first thought? I mean, can he really tamp down inflation with piecemeal 50 basis point hikes here?
I didn't see it as piecemeal. I mean, he put in 50 basis points for the next 2 meetings, which gets them off almost up to the neutral rate, and they want to go beyond it. And they're increasing the pace at which they reduce their balance sheet by double what we saw previously. and that will be fully in place by August. The reductions in the balance sheet amplify rate hikes. It's one of the reasons why we've seen such an extraordinary rise in mortgage rates relative to the 10-year Treasury yield. And I think that's very important to understand, is that small moves off of these low rates have outsized impact on interest expense. And that's something people lose in translation as well. It's very costly. I did a calculation just on, average mortgage costs and how much they've gone up with values since December alone to April. Okay. If home values hold in April at the March levels, it's still over $500 a month. That's extraordinary.
It is. And if we look, we can see that the home builders are getting crushed along with the rest of the market. I mean, we do have, obviously, a big sell-off here. Dow Jones Industrial is down 1,212 points at this moment with 17 minutes left to trade. And the home builders, you can see it on your screen. Everybody, these are increasing losses here, by the way. Just about everybody's down 5 to 6% or more. Diane, great to see you. Thank you very much. Economist Diane Swonk.